Let's try and go to Bill Evans now, Chief Economist of Westpac. He said today he thinks the Reserve Bank should raise interest rates by 0.5% on Tuesday next week. I asked him why he came to that conclusion.
We have to say that the markets are pretty much convinced that it'll only be 25, but the facts have changed. They've changed extraordinarily. That inflation number yesterday showed us that inflation is much more entrenched, much more widely distributed through the economy than we're expecting. And I'm sure that if the Reserve Bank had been aware of that number last month, they would have done 50.
OK, so take me to those inflation numbers. Does that give fear that the inflation in Australia's economy is now more broadly spread and more difficult to get out of the economy and therefore requiring higher interest rates?
That's what the number was showing us, Ross. 90% of expenditure items are now growing at 2.5% or more in inflation terms. Compare that to the mining boom when it was 63%. If you look at the outright number, that's the highest quarterly inflation report we've seen for underlying inflation since 1988 and the highest annual number since 1988. So that's come as a surprise. And then when you superimpose upon that the news that we got from the government during the budget papers that they're expecting electricity prices to go up by 50%, then the risks are building that inflation gets embedded in the system. Now, Ross, I'm expecting the economy to slow down substantially next year, but I expect that if inflation comes under control, which is my current forecast, that the RBA will be able to cut rates in 2024 and provide some relief for the economy. But if the inflation becomes entrenched, the economy will still slow down, and that inflation, that rate cut relief that I'm hoping for 2024 will have to be postponed for quite a while. That's where I see the worry.
So the worry, what would be the signs that would give you the worry to change your forecasts about when the Reserve Bank starts to cut interest rates?
If we start to see inflation or expecting to see inflation holding up nearer the 4% than the 3%, then we would have to query whether the RBA will be able to cut rates in 2024. And that's this whole point about stagflation. Stagflation is when you have very weak growth. That's pretty much guaranteed for next year. Government's forecast 1.5%, our forecast 1%. That's pretty much guaranteed. The question is, what is the inflation rate that we'll be dealing with at that time? Now, what we would like to see is the inflation coming down sustainably so that we can provide monetary relief in 2024. If that is not happening because it's so widespread, there's so much confidence about inflation in the economy, and we're also seeing these external factors around electricity, then it means that the relief in interest rates that we will desperately need by then will have to be delayed. And that's why I'd rather see that inflation challenge addressed now rather than a 25 basis point indicating that it's work as usual, rather than responding to the fact that the inflation story has changed really rapidly and really threateningly.
Because one anecdote that comes out of the back of last month's rate rise of 0.25% rather than the 0.5% that the markets were fully expecting was really auction clearance rates. It almost seemed as though property buyers thought, oh, well, the big rate rises are now over. We're now safe to get back into the property markets. But if what you're saying bears out, then it might be less safe as a result of interest rates being higher for longer.
That's right. So people become conditioned to 25, it may well have that impact. We saw in our consumer sentiment survey, which went for 4 days, on the first day before the Reserve Bank decision, the outlook for house prices fell from an index of 100 to an index of 85. Once it was seen that the Reserve Bank was only going by 25, it went from 100 up to 109. So people actually responded to a rate hike in a positive relief style sense. And if they continue to do, if they do that again this time, which everyone is absolutely convinced will happen, then it'll have the same effect of really not impacting upon this inflation confidence that we need to impact upon at this early stage before it becomes even more widespread.
So is what you're talking about that the rates won't come down, that they'll just remain at a point where they're steady? Or is it a case where the Reserve Bank might have to continue to raise the rates to actually quell the consumer demand and to make certain the inflation is flushed out of the system?
Well, that's the issue, and as the inflation gathers more momentum, becomes more widespread, what I call inflation psychology takes over. So businesses feel that finally, after 20 years, they can actually raise their prices, and consumers accept the fact that the businesses are raising their prices because it's all about inflation, isn't it? And they think they can get a pay rise to compensate. Once that starts to get entrenched in the system, very hard to get out, and it may well be in a context of quite weak growth, which of course would mean that the Reserve Bank would have to keep raising rates, and that would be unnecessary if we break that nexus earlier rather than later.
I'll tell you what, it's a big call from you today, Bill. I recognise that, because to go back to 50 basis points after having already reduced it down to 25, we'll see it all unfold on Tuesday next week. Many thanks for your time as always.
Thanks a lot, Ross.